So what are available benefit options?
There are 5 key areas for the major moving parts of a policy. The daily or monthly benefit amount, how much of that benefit amount is home health care, how long a policy will last, which is denoted in benefit years, the elimination period, the wait period, and finally, inflation.
Could you explain a little bit more about what the daily and monthly benefits are?
For the daily and monthly benefit, that's going to denote how much you can have in a particular period. For a daily benefit, if you had $200 a day and you used $100 on Sunday, nothing on Monday, and $300 on Tuesday, it's only going to look at a particular day. So you get reimbursed only $100 on Monday, and Tuesday you could only get $200. So monthly is better. You'd have flexibility to use care when you need it, and you'd have up to $6,000 in a given month if you pick that.
Could you explain a little more about what the home care benefit is?
Home care benefits can be a percentage of the daily or the monthly benefit. It's according to different contracts. It could be 50%, 75%, or 100%. I would recommend 100% because home health care is ranging, around $21 an hour. So what is $10 an hour going to pay toward care? So it's better, you could spend more money on home health care than you would pay for a facility.
What is the benefit period? How long is that? How's that calculated?
The benefit period is a multiplier. So let's say you had a $6,000 a month plan. So 6,000 times 12 months to give you $72,000 a year times 5 years would give you $360,000 as a benefit pool. So that's how much your quote long-term care checking account is at inception of the policy. It's money definite, not time definite. So we don't care if you used $3,000 a month, it'll last 10 years.
How is the benefit period calculated?
The elimination period is the deductible, the time that you're going to pay out of pocket before your policy starts paying benefits. So if you had a 90-day elimination period, and it was a calendar day, the first 90 days, you're going to write checks for, and then the policy will kick in.
Could you explain a little bit more what you mean by elimination period?
The elimination period is the deductible, the time that you're going to pay out of pocket before your policy starts paying benefits. So if you had a 90-day elimination period, and it was a calendar day, the first 90 days, you're going to write checks for, and then the policy will kick in.
And how are they factoring in inflation?
Over time, the cost of care is going to increase, and it's important to address that eventuality in the policy. Depending upon the carrier, there's several different ways to do this. You can have a guaranteed purchase option where you purchase additional coverage every year or every 2 years to keep pace with increasing costs. Or you can have automatic increases based on changes in the CPI, the Consumer Price Index, where you can have a fixed increase every year based on a 3, 4, or 5% automatic inflator.